Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis on Friday, November 14, 2014. You're looking at a daily chart of the SPY, and we have a lot to cover tonight, so put your seatbelt on. All right, so market's been chopping around. We put in a whole host of doji days, and basically over the last 11 trading days, the market's been in a tight range day by day. So the intraday daily swings have been really, really narrow, which is a sign, it's really a sign of one of two things. It's a sign of market exhaustion, or it's a sign of market consolidation getting ready for another move higher. And that's the point we're at right now. We're at an inflection point, and I know I sound like a broken record, and I've been saying this over the last several sessions. That's because the market hasn't done anything yet, and we're at an inflection point where the market's going to break out one way or the other. It's either going to break out or break down. And when I say break down, I don't mean it's going to break all the way down like this. We're looking for a correction to correct some of this overbought condition and ready for another move higher into the end of the year through the holiday season. We usually get a Christmas rally, and I'm looking for another Christmas rally somewhere around after Thanksgiving into the Christmas New Year holiday, and the volume will dry up in the entire market, and the market should float higher, but not before a pullback, in my opinion. However, we can certainly break the other way next week. But here's the deal. Next week is options expiration week, and generally during options expiration week, you have a lot of whipsaw action. The market goes up one day, it goes down the next day. It goes up one day, it goes down the next day. And typically what you're going to see for the next 5 days, or maybe 4 days, and Friday should probably be a nothing day after about 10 or 11 o'clock in the morning like it normally is, but You're normally going to see maybe Monday will be up, Tuesday down, Wednesday up, Thursday down, Friday up slightly, and then that's about it. How much down? I don't expect the S&P. Okay, we'll talk about the S&P cash index. I don't expect the S&P to come beneath 2,000 or much below 2,000. If we break below 2,000 considerably, the next target would be about 1960. I don't think we're going to get down there, certainly not next week unless some catalyst happens and the market really scales down. But I don't see that happening. There's too many bulls out there. There's too many people that are ready to buy the dips that feel like they missed this move. Therefore, they're going to have an itchy trigger finger, and any sign of a pullback, you're going to see buyers come in. So that's what I'm looking for next week in the major indexes, namely the S&P. And, certainly be careful, because I wouldn't be short the index necessarily on Monday, because you never know. We could go break higher, and I've been telling you, we'll go over to the E-mini contract, just talk about it for a minute. The S&P E-mini contract, we got as high as, 20... Let me just bear with me, folks. I'm going to my other chart here on the other screen. And the reason I don't show you the other screen is because this chart's a lot prettier. And I'm going to consolidate them one day. But for now, I'm just going to tell you what that number is. And the high was 2043.75. 2043.75. That was the high. And I've been telling you that I still have a target on the upside in the S&P E-mini contract of 2050 to 52. So that can certainly be achieved as early as Monday. If it is, I believe we'll pull back off that level and be down Tuesday. I have a cycle, a short-term cycle down on Tuesday. We'll see if that works out. But nevertheless, I still have that target at 2050 to 2052, and I'm watching that. So we haven't achieved that yet, but look for it. You never know. All right, let's move on, and I'm going to go over quickly to the IWM, because the IWM over the last couple of days has been a little bit weaker than the S&P. And right now, let's see, yesterday's low was 1662. Today's close was 1669. That's important because we didn't close below yesterday's low. Had we closed below yesterday's low, I'd feel more comfortable in telling you that we're probably going to pull back in the IWM as soon as Monday. But they pushed the market up and closed above yesterday's low, which puts the market not necessarily bullish position, but it's not as bearish as it would be if we closed below yesterday's low. So if we pull back in the IWM or the Russell 2000 index, I wouldn't be looking for anything more than 112 on the downside right now. Maybe on a watershed decline, we might get to 111, maybe even 110, but I don't see it. My calculations are telling me 112 to 112 and a quarter, this 50-period moving average, and that would be about it on the downside, which is a pretty good move. But here's the good news. When I talk about these down moves, okay, you don't have to play them down. You can wait for the market to come in a little bit, and then you can play the end of the year rally. So I'm looking for a pullback next week, and I'm going to be a buyer at some of these levels for the end of the year rally. So the IWM, the S&P, and then there's a whole host of stocks that I'm going to be putting out to members, the subscribers on the Trade Alert service that are going to be looking for a bullish run into the end of the year. Now, let's flip over to gold because we saw an interesting deal happen today in gold. Remember last night I said that this triangle pattern will usually break one way or the other. It usually breaks in the direction of the previous move. And I told you I wasn't sure because we had this big down move. Then we put in this triangle and we can continue down. And I was still looking for 1100 on the downside in the price of gold futures contract. And today we did the opposite. Of course we did the opposite. That's Murphy's Law. Anybody know Murphy out there? So we broke up and we never got to the 1100, but that's not saying we can't get there. However, it becomes less likely because of the move we just put in. Now, certainly we're going to pull back, I would think, and then you can be a buyer of gold. And I'm going to put out an alert to the members of the Trade Alert service for some gold and gold mining stocks shortly. When I see that a bottom is definitely put in, certainly we can just shoot higher from here. But if we do, I don't think gold futures would get much over about 12 and a quarter. Today we closed on the futures contract at 1187.90, call it 1188 rounding. And we got as high as, I think, 1193, I think it was. So on GLD, I'm looking for really this 50-period moving average would be a good target. That would coincide with about 12 and a quarter on the gold futures contract. And then we'll have to see how it reacts off that level and see what happens. But I do think into next year, gold moves higher. And I'm looking for this gap fill here above this 200-period moving average at about 123, 122, 124. And but that's not going to happen until into next year. And the reason that's going to happen is there's a myriad of reasons. While the central bank here in the U.S., the Federal Reserve, stopped printing money, Japan started printing money almost the following week. And that was obviously programmed, that was coordinated by the central banks. And there's one more that hasn't come to the window yet, which is the European Central Bank, Mario Draghi. Now, he's been working over the German Chancellor Merkel because she apparently is the only thing standing in between him printing money and the euros and not printing money. And Germany has to give the go-ahead. And I guess the German parliament has to approve what he wants to do, and I don't know whether she's behind it or not, but nevertheless, until Germany comes to the window, they're not going to let Mario Draghi print money. But I think that'll happen, and when it does happen, and Japan and Europe are printing money at the same time, look for gold to take off, and gold's going to get up to 13, maybe 1340, 1320, 1350, somewhere in that neighborhood. That's a pretty good move from here, so we want to pay attention to that, and we can certainly benefit on the upside from that. In the short term, one of the other reasons why I like gold on the long side is because of the dollar. Now, I'm going to look at the UUP chart, which is a proxy for the dollar. It's an ETF. And what's happened is there's been, I'm going to go over to a longer term because I want to show you the type of move we just had. Now, this is a weekly chart. Okay, so from July, we had this straight up move, a parabolic move. in the dollar, and the dollar has to pull back. And the dollar right now is at 87.62 on the close today. But what happened is we made a high today at 88.36 and a half. Now, 88, not that that's a meaningful number just by in and of itself, but what happened is now I'm going to show you an intraday chart of the UUP, and you'll see that the UUP gapped up higher. And remember, I've said in some of these videos of recent, when you want to put in a market high or low, you want to see a gap for a high. You want to see a gap up and then a dump out for the rest of the day. And that's what we saw today. That's a top. Okay, let's go to a daily chart one more time. And this is a reversal day. You see this red candle engulfing all these days here. This is a reversal day. Now, what happens from here? The dollar pulls back, and it comes at minimum into this 20-period moving average and probably down towards this gap fill here, maybe even to 50-period moving average. And once that happens, we'll see what type of pattern it puts in from there, and I expect it to move higher into next year. However, right now, one of the reasons why I'm bringing this up is because as the dollar pulls back, I would expect gold to move higher, and I would also expect oil to move higher, and that's a good segue. Let's look at the USO. And what happened today in the price of oil was crude oil was overnight, crude got down to around 73 and change. You know what? Let me get you the number just for fun. Bear with me. I'm on the other chart on the other screen that you can't see. And let's see, the daily chart. And I want to get the low for us because it is important. The low was 73.25. Now, I've been telling you that my target was 74, and being that we broke 74, I'm not ruling out 72 as the final low. We'll see if we get there. We don't have to get there. However, if the market sells off at any point next week, we can have a sell-off in oil, and we can hit that 72 number. And I think that 72 number is a buying opportunity for the energy sector. And again, the members will get their trade alerts in the energy sector that I have a laundry list waiting for oil to bottom, and we're close. And even if it doesn't bottom at 72, I still think we move higher, but we still have to get over this number, $30.17 in the USO, which is also coinciding with the 20-period moving average right now. This is going to continue moving down a little bit as time goes on, but right now, when we get above this level, you're going to look for higher prices in oil or the USO. But right now, it's kind of still wait-and-see mode, so I don't want to do anything yet. But I'm giving you the tell of what's going on, and I would expect higher prices in oil, higher prices in gold, higher prices in the stock market into 2015. Not for 2015, but right now, into January of 2015, and I'll let you know more what's coming in 2015 when we get there. But right now, that's the take on the price of crude oil. So I already talked about the dollar, and there's one other thing I wanted to go over, which is, well, just bear with me. I'm going to get rid of this chart, and I'm going to bring up the transportation index. And the transportation index has been extremely strong also, and it's putting in a consolidation pattern up here. Now, even if we pull back next week, if we stay above this low here at 89.4811, that's very bullish, and I would expect higher prices. But the reason I bring this up is because if we pull back in the if we pull back in the dollar, okay, and price of oil goes higher, that's going to put pressure on some of the transportation stocks, which is going to in turn put pressure on the transportation average. So you see how these markets can be linked together, and that's why I'm bringing it up, is because some of the airline stocks have actually had parabolic moves. Let's just take a look at a couple of them. Delta Airlines, Southwest Airlines. I mean, look at some of these moves. United Airlines. These moves have just been tremendous parabolic moves, and they have to pull back in order to go higher. Markets don't go in a straight line. They never do. But remember, everybody gets bullish as the market's moving higher. Everybody gets bearish as the market's moving lower. And as these moves occur, they get more and more bullish, in this case, in the direction the market's moving. And the sentiment becomes so extreme that people believe that the market can never come down. And how many times have we gone through that scenario where the market can never sell off? It can never come down. We were in that scenario through the summer. Okay, we got into September, and what happened? All of a sudden, the market cracked. We came down 10%. And don't forget, that's in a market that everybody believed could never come down. The markets can always come down. I'm not saying they will. I'm just saying markets can always come down. They can always go up. They can always go a lot higher than you think, and they can go a lot lower than you think. But when the sentiment becomes so extreme, which is where we are right now, and we were here before the September-October correction, the sentiment is so extreme, we're about the same level right now, that everybody's bullish. And when everybody's bullish, usually you look for some kind of a pullback because everybody seems to get caught by surprise. And you'll see, when we have a down day, the media on Tout TV or CNBC will wonder why the market's selling off. Why is the market down today? I can't believe it. And they look for a reason why the market's down. And you'll hear Russia and the Ukraine, or you'll hear something else, or whatever the flavor of the day is. That's what they'll pin the reason on. But the reality is the reason's going to be because the market needs to pull back a little bit in order to build up some power to go forward again. And that's just the way it is. It's always the way it is, but nobody ever seems to believe it until it happens. It is the phenomenon of the market. Sorry, folks, the video was paused, and I'm not sure exactly where it paused, so I'm just going to go over something real quick, and if it's repetitive, I apologize, and if I skip something, I apologize, but the meat and potatoes of the video is here. I just wanted to point out something that happens at the end of the day. And like, for example, today we're going to look at a 1-minute chart, and I just want to prove a point that the institutions will whip the market around next week during options expiration. And on a micro scale or a small scale, you can see what happened today. 3:58 in the afternoon, 3:59 in the afternoon. That's no accident. The institutions ripped the market up after they took it down, and they're probably buying call options, and they take money right out of the market at the end of the day, last couple of minutes. And if we go over back to yesterday, I can show you where the same thing happened. Let's go. Where's the 13th? Here we go. Where's the end of the day? Here we go. Okay. 3:58 in the afternoon, 3:59 in the afternoon. So on light volume days, the institutions can whip the market around whenever they want because they're playing with tens of millions of dollars on each trade if they choose to. These are the institutions: J.P. Morgan Chase, Goldman Sachs, Deutsche Bank, HSBC, Royal Bank of Canada, just all kind of, just the list goes on and on and on. Morgan Stanley, so UBS. So the list goes on, and all these institutions, they manipulate the market. They decide which way the market's going to go, and the individual investor can get really shafted if you're not paying attention. On light volume, you never want to be short the market on light volume because they'll rip it in your face. And so that's basically the point that I'm trying to make, is on options expiration, it gets magnified, and they do the same thing all week long. So they'll do it on Monday, Tuesday, Wednesday, Thursday, and Friday's kind of a nothing day, usually like it was today. But in the morning on Friday is where all these option contracts settle out. So you get a lot of heavy volume and whipsaw action up until about 11 o'clock in the morning, and then the market just goes in float mode all day long, or kind of goes to sleep on Friday, like it did today. But next week is Options X, so what you're going to have is a lot of whipsaw action, so just be careful. But after that, if we get a decent little pullback, and I'm not looking for a lot, but a little pullback, we're going to look to buy that pullback, and the members will get their trade alerts, and we're going to look to be long the market into the holiday season, right into January for the most part. And that's about it for tonight, folks. I know it was a long video, but I hope it was helpful. I'm sorry about the blip at the end a couple of minutes ago, but somehow it got on pause and I didn't realize it, and I don't know how long I was talking for while it was on pause. Nevertheless, I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.